Welcome back to Investing Wise Academy, people. I am Fred, and now we're going to discuss Cathie Wood's rise and fall. And as some of you may already be aware, Cathie Wood is now the most well-known financial manager, and now she oversees over $20 billion in investments and has emerged as the face of disruptive technology investing. She was a little-known manager 3 years ago, and very few on Wall Street took her seriously. But in April 2019, she appeared on CNBC to discuss her $4,000 prize goal for Tesla, which indicated a potential upside of more than 15 times. Wall Street was largely in agreement at the time that Tesla was overvalued and that the firm was in danger of going bankrupt. Early in 2020, when the pandemic began, Tesla stock began to soar, and Cathie Wood's Ark Innovation ETF jumped on board. At its peak in February 2021, the Ark Innovation ETF significantly outperformed the S&P 500, rising more than 160%. The Ark company was the largest actively managed ETF at this point, with Cathie Wood managing more than $50 billion. Ark has been more than reduced in half since the disruptive innovation boom burst, though. The Ark's performance in comparison to the S&P 500 has nearly vanished. Critics of Cathie Wood claim that she just got fortunate when the Federal Reserve printed trillions of dollars to construct a bubble in high-growth tech companies and that the bubble has finally burst. In this video, we'll explore Cathie Wood's rise to prominence as the face of disruptive technology and consider if her ETFs will succeed in coming back. While serving as the Chief Investment Officer at the asset management company Alliance Bernstein, Cathie Wood had the first concept for the Ark Invest. She saw a huge potential for new technologies to disrupt the economy and produce the following trillion-dollar businesses, including electric vehicles, artificial intelligence, and genomics. She also wanted to create an investing product so everyone could access these stocks. She was intrigued by the real-world effects of disruptive technologies, and she understood that she could also take advantage of current financial market advances. And ever since, the exchange-traded funds, or ETFs, have recently gained a meteoric rise in popularity. Before ETFs emerged, mutual funds were the only alternative for individual investors. You must open an account with a business and complete a ton of paperwork if you want to invest in a mutual fund. With an ETF, you may quickly and easily purchase it through your current brokerage. Additionally, trading in and out of ETFs anytime you want is simple and costs nothing. The ETF is a much easier and more effective alternative. In the past, most ETFs were passively managed and tracked indices like the S&P. Actively managed funds were still mostly set up like mutual funds. Cathie Wood believed that there was no justification for this to be the case. Additionally, she could quickly raise the number of assets under management if she created an actively managed ETF. Because investing by regular investors is so simple, she could charge less since it would be less expensive to run. She presented her idea to Alliance Bernstein's senior management team in 2014. She intended to establish an actively managed ETF to invest in innovative technology companies. The bosses rejected her plan, telling her that it was too dangerous. She then quit and started Ark Invest. She turned to her close friend and fellow devoted Christian Bill Huang for early seed money. You may recall Huang as the investment fund manager who had a spectacular meltdown after using 5 times leverage to purchase equities. Among them are Viacom and Tencent Music. She established her flagship Ark Innovation ETF on the New York Stock Exchange after receiving her initial investment of a few $1,000,000 from Huang. The majority of actively managed investment funds focus on specific industries or regions. So you may say, for instance, have someone who is a specialist in European car stocks and another who is an expert in North American utility companies. According to Cathie Wood, analysts who follow such stringent investment philosophies tend to become bogged down in the details and lose sight of the larger picture. According to Cathie Wood, a new technology radically upends the economy every few decades, like the introduction of the telephone in the early 1900s or the growth of the personal computer in the 1990s. The notion is that if you can predict the forthcoming technological platforms before everyone else, you'll be able to purchase the Amazons of the following decade when they're still affordable. Cathie Wood selected 5 innovation platforms, including artificial intelligence, energy storage, robots, DNA sequencing, and blockchain technology. And she believes this will alter the economy over the next 5 to 10 years. One of the first equities she found using this methodology was Tesla. Tesla was also at the time considered to be ridiculously expensive by the majority of Wall Street hedge fund managers. The price-to-earnings ratios of the established automakers, including Ford and GM, were less than 10. Tesla had an unlimited PE since they were losing money. So why would someone want to own such a stock? On the other hand, Cathie Wood saw Tesla as a disruptive technology business rather than a vehicle manufacturer. Their complete self-driving technology is compatible with the AI technology framework. Their efforts with the Powerwall and industrial battery products are consistent with the energy storage platform. They also profit from the quick transition from internal combustion engines to electric automobiles. She announced her 4,000 price target for the manufacturer of electric vehicles in 2019. They would need to become the most valuable car maker in the world by a wide margin to achieve this potential upside, which was greater than 15 times. Most people laughed at Cathie Wood because they thought her pricing aim was ridiculous. However, Tesla began to surpass projections in 2020 significantly. When their factory automation was fully perfected, they began producing Model 3s and Ys at an alarming rate. Despite challenges connected to covert operations, they supplied 500,000 automobiles in 2020, and in 2021, this almost increased to over 900,000 cars. They had been burning money for years before their investments started to pay off, and they swung into significant profitability. Cathie Wood was among those who benefited the most, and Musk was able to verify that the short sellers were wrong. Additionally, after accounting for the 5-for-1 stock split, Tesla's current pricing is $4,656. Her profitable Tesla investment raised her profile well above Wood's price goal. By the end of 2020, she would become one of the most well-known fund managers on Wall Street, and it wasn't even just Tesla. She also made significant investments in technology companies like Zoom and Teladoc, which greatly benefited from the epidemic. Her Ark Innovation ETF rose more than 160 at its high in February 2021. Ark managed $50 billion of assets across its many ETFs. These increased their size over Citadel, even though Citadel only charges an expense ratio of 0.75% on a base of $50 billion, or $375 million in fees annually. But the celebration wouldn't go on long. Ark Invest began to suffer from its success as it became larger and more prosperous. After each trading day, actively managed ETFs are required by law to provide a complete list of their holdings. So retail investors began examining Wood's disclosures and emulating her whenever she made a new stake in 2020 because of her success with Tesla and some of her previous investments. Attempts by automated traders to outperform individual investors probably made this situation worse. This resulted in the Wood effect, which can be easily observed with Robinhood, whereby equities would climb significantly in the days following inclusion into an Ark ETF. In late July, a $38 value per share was used for the Robinhood IPO. After the listing day, the price dropped a little, and Cathie took advantage of the chance to purchase shares for roughly $45 million. Retail investors began to flood the market weeks after the purchase, driving the stock to an intraday high of $85 per share. Cathie Wood has a significant issue with this. She must complete all the investments in one trading day if she wants to create a new position. The Wood effect will compel her to purchase at a lower price if she purchases a stock over some days. However, the Wood effect cannot be avoided due to the ETF structure. The open-ended nature of the Ark ETFs implies that if you purchase 100 worth of one, 100 will automatically be broken up into further shares of the member firms. Therefore, she is forced to continue buying shares at ever higher prices as long as her money rises. The reason Cathie Wood stocks benefited so much for the epidemic is something else to consider. The Federal Reserve lowered interest rates to zero and issued trillions of new dollars to support the economy. As a result, inflation increased simultaneously as the federal government launched previously unrecognized stimulus initiatives to put money in the wallets of regular people. Real interest rates become significantly negative as a result of this combination. Many Cathie Wood's investments are loss-making, or in certain circumstances, pre-revenue businesses. Any possible earnings they could generate are several years away. The value of these equities soars as real interest rates decline. She didn't purchase those equities for this reason. Instead, she was fortunate that the Federal Reserve's experiment with money printing greatly benefited her investing approach. The Fed will be obliged to boost interest rates back to normal levels since the situation cannot last with an inflation rate of 7%. As interest rates rise as the bubble deflates, the timber stocks that benefited the most from the bubble's inflation inevitably suffered the most. Although the Fed has not yet raised interest rates, the stock market is a system that looks forward. The Ark stocks almost wholly reversed their outperformance from the previous period as it became clear that the Fed would have to take action. And the decline has been stunning for many of these equities. For example, Barclay Lights, a speculative biotech business, has the Ark Invest company's single worst stock performance record. Additionally, they have created a brand new system that recognizes and evaluates cells using light. Despite the potential of the technology, it will probably be several years before it becomes profitable. They are losing tens of millions of dollars per quarter while expecting to generate $90 million in revenue in 2021. It is very challenging for a stock price to drop by 90% when a company is profitably operating. If the cost to profits multiple were 30, a 90% drop would reduce your earnings to 3 times when you were making, which is ludicrous. But there is no cost to the earnings multiple for a business like Barclay Lights. As a result, stock prices can fluctuate wildly depending on market mood. Early-stage disruptive innovation stock is hazardous because of this. Cathie Wood has recently performed poorly yet still stands by her beliefs. According to her, fears about increasing interest rates are exaggerated, and the recent dips in innovation stocks position them for a significant future return. She still has a strong track record over the long run. Since its launch in 2014, the Ark ETF has returned 278%, or more than twice the S&P 500's gain of 125%. A bubble inflated and then deflated, which was a kind of an aberration in the pandemic era of 2020 and 2021. But she continues to do well, at least for the time being. Okay folks, that concludes this video. What are your opinions about Cathie Wood? Do you believe she will recover? Comment below with your views and let us know. As always, I appreciate you watching. My name is Fred, and I'll see you in the following video. If you are new to this channel, please subscribe.